market structure. So it's kind of in the name what we're going to be looking at, and it is structure. So it's how the market is structured and how it moves and how it reacts to certain zones, and how you can use this to sort of predict and see where the market's headed. So let's get into it. So from the last lesson of candlesticks, you remember me talking about areas of interest, or areas where price likes to react. And we see these areas by reading what market structure is. So market structure is generally how the market moves. The market either trends up or down or consolidates. So you can either go up, down, or range bound. That's the only three things you can do. So keep it simple. It can either go up or down, really. Price likes to come back to a mean or moving average, and price often reacts to support or resistance levels. So these are our areas of interest, and price also likes to come back to where large bank orders will be, seen by wide range bars, or where stop or limit orders will be waiting. So we'll get into where you can see these when we get onto the charts later. So over time, you'll be able to read a chart without having to draw any lines. The market moves in waves, and it's your job to surf them. Price flows up and down, but sometimes it breaks these structure levels. Very briefly, I'll just show you what I mean, and I'll talk more about it later as the video progresses. So we can have resistance over here, resistance, resistance, support, price comes back, support again, which is this area. As you can see, price has broken below, so this support hasn't held price from going down. So it's broken this level of structure, and now price is probably going to head down, and we can target these next levels where price is going to be. So more on that later as the video goes on. So now, in relation to market structure, I'll just draw out a simple pattern so you guys can see. So in an uptrend, we'll be having higher highs and higher lows. What do I mean by this? So from my previous video, you would have seen why we have legs in the market, why it doesn't just move up in one direction, why it has these legs. And now what I mean with higher highs and higher lows is if you draw a line across the previous high, you can see we have a high, a low, a higher high, a higher low, a higher high, a higher low. If you draw a line across, you can see that it's not breaking structure. It's keeping its structure towards the upside. It's like building levels. Now, if we do break the previous structure, and we have a candle close below, this is the areas of interest that I was talking about in the last lesson. One of the many areas of interest we have, but if we have a strong close below that previous structure level, you may see a reverse coming. We'll look more into this on a live chart later. So what time frames do we look at to see this market structure happening? As I've been saying throughout this course, the higher the time frame, the better the indication of either a candlestick or market structure or anything really is. So lower time frames will confuse you as it's choppy and it will often give you false signals. I like to look at the daily or 4-hour charts to have an overall trend and mark out my support and resistance. However, I use the lower time frame like the M5 and M15 to enter my trades. So we'll look more into that later. A break of structure refers to a significant change in the market's price pattern, indicating a potential reversal or continuation of a trend. This signals that the trend may be weakening or reversing. So we're coming up here, having our higher highs and higher lows. We've hit some sort of resistance here. So price does not want to go any higher than that. Now we see price come down, and it's coming to a strong level of support. Now this is an area of interest where we have our alarm set, where we can look for either a bounce off by looking at the candles or a break of structure towards the downside. So a change of structure is just marked as choch, meaning change of character. So if it breaks below this level, it's very likely that it's going to run to the next level of support that would be even lower. For this example here, you can see price failed to break through and it bounced off. So this is not a change of character. It's continuing. It's come back down, grabbed liquidity, and carried on the move. So as I said, if it broke through with a strong bearish candle, we'd expect it to hit the next lower support or a strong wide range bar. More on this later. Here's that same chart but from a higher time frame. So obviously you can see we're having higher highs and higher lows, and we're not breaking structure at all. So we're just coming up, we find a bit of resistance, so price doesn't want to go any higher than this level. Price eventually does come down, and it's reached a strong level of support right here. So this is an area of interest right here. So I've set my alarm, and I'll look at the candlesticks when it comes to this level. So it's reversed and it's gone up, so it's completely rejected it, and price is going to move higher now because of that. If it were to break below the strong candle, it would typically come back, retest this zone to continue its move down. So that's us seeing support turn into resistance, which it does often. Your next target of price may be this level here where we have resistance, resistance, and support. So you can use market structure for targets as well as entries, and you pair that with your candlestick knowledge like I showed in the previous video, and you can get a better indication of where price may be headed. A really good area of interest is support and resistance, and these are easily found and easily drawn out, and these are strong structure points. So at these points you can see where there might be a breakout or a retest or a rejection to where price is going, and you see these in the candlesticks. So these points can be found looking from a higher time frame. A support level is a price point where the asset has repeatedly bounced up in the past. So you think of it as a floor. Price isn't going to go lower than that level. Second thing is resistance, and you're going to want to think of that as a roof. So price isn't wanting to go higher than that level. So resistance, roof or ceiling, price isn't going higher. Support, floor, price doesn't want to go lower. Have a look at support and resistance. So remember, resistance was a roof, support was a floor. You often see support turn into resistance or resistance turn into support. So let's have a look at this chart. So the ceiling, I've drawn these rectangles out. Resistance, 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 resistance. Price doesn't want to go higher than that level. We also see resistance here, 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 here. So that's the roof. For the floor, support. It's supporting price, so price doesn't want to go lower. Support, 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 support. All of this is support. As you can see, this support here turned into resistance, and actually in the past you can see it was resistance over here and over here and over here once again. So this resistance turned support. Price touches the same areas over and over, and this is because this is where bank orders will be sitting. This is a good price for them to enter or leave their positions. And as you can also see, price is just moving up and down. So we have a nice buy up, profit take, buy up, profit take, buy up, profit take, and it just moves up and down over and over. So you got to look for these key areas of interest to where you want to enter trades. you're not going to enter a trade in the middle of a range. It's just stupid. You're going to have to wait for an area of interest. So why are support and resistance levels good areas of interest to look at? So support and resistance is a level where banks and institutions will typically have pending orders waiting. So buy stops, sell stops, buy limits, sell limits. It's a price where they're either happy to buy or sell from. That's why you typically see these levels respected, meaning they're keeping their market structure. They're not breaking below or they're not breaking above. Over time, you'll be able to open a chart and point out where these zones are very quickly. However, it is important to remember that these zones are subjective to each individual. So you can see them, most people know where to draw them, but on a lower time frame, everyone might be seeing their own sort of lines. So with that in mind, we'll take a look at wide range bars later on. Now these wide range bars are a bit less subjective, and you'll see why later on in this slide. So what if support and resistance is broken? If support is broken, price likes to retest that level again, and often times a strong level of support turns into a strong level of resistance, like I showed you in the previous slide. So we'll have our resistance in the past, we're going to break out, and now it's going to be our support level. For how long? We never know, but that's just what it does. If it breaks out, it's going to retest, carry on. So it's going to retest these levels over and over again. So these are key levels of interest, meaning banks and institutions will either have buy limits, sell limits at these levels. There is a lot of volume at these levels, and price typically has some sort of reaction at these zones. A strong level is a monthly low or high. You can also use weekly highs or lows. So let's have a look on the next slide. So just like before, we have support, support. Now we have resistance becoming support. So price didn't want to go above this level. It eventually does. And guess what? It comes back and then it doesn't want to go lower. So this resistance has now turned into support. This support breaks, now it turns into resistance. Wide range bars, what are they? So much like support and resistance, they are areas of interest. Why? Because it's large bank orders where price will be bought or sold from, and price is going to retest these zones because these buyers need to become sellers, these sellers need to become buyers. So it's more of a mechanical way of seeing where price is likely going to touch again in the future. These zones are less subjective because you can actually see them with the candles. The candles are what draw them out. So a big order here, retested, carried on. Retested again. These are not subjective. These aren't just lines that you would draw out. They're printed because they are large bank orders. Price likes to test levels it has in the past. Remember that. If you take a position expecting price to move like it has historically and it moves against you, it's most likely that it's going to move to another zone or area of interest where it might take an opposite position. So let's just say for whatever reason you think price is going to bounce off here and it doesn't. Now you might be looking for another level of support where it might bounce. If it doesn't and it continues against you, okay, it could bounce from this next level here where there's been retest. So now this is support. And it has some sort of weird wiki day and it comes back down to a level of support. So you can just see how you can look at these structure points as to where price may be reversing to help you in your trading. This is back to wide range bars, and as I said before, it's a large bank order. So you can see this candle right here. There's a gap between the lower candle and the previous candle, and that's what draws out this rectangle, which is just essentially showing us a large bank has placed a sell order in right here. So it's going to retest when they take their profits. You can also see over here we had a large gap with the candle, and price retests it to carry on. These points just keep getting touched over and over again. Supply and demand sounds pretty similar to support and resistance, and it kind of is. So it is pretty much support and resistance, but there are a few key differences which make them supply and demand. So supply and demand are points where the price has an accumulation before a strong push in one direction. Supply and demand zones are not fixed or certain points. They represent areas where one trader may identify them while another may perceive them differently. So it's not as mechanical as wide range bars, and it's pretty much the same as support and resistance when it comes to how everyone sees them differently. You can use supply and demand zones on most time frames. For a quick scalp, you may use them on the M15, and for a longer swing, you may use it on the H1 or H4 chart. So we see price accumulating, price then moves sharply in one direction. We can assume that price may retest this zone, or at least to a Fibonacci level. Supply and demand can be interpreted differently between one trader to the other. One trader may use previous contrary candle, where the other may highlight the whole box. So this is the contrary candle, the blue candle before. Right here, someone may draw off the blue candle, or someone may highlight the whole box, meaning the accumulation. Like that. So it's different for every trader, and it's important to remember that because it's not mechanical like the wide range bars. Let's have a look at Fibonacci retracement levels. So a Fibonacci retracement is a tool used to measure the extent of a strong price movement. The Fibonacci tool highlights the percentage levels of a pullback. The Fib level is a psychological level, meaning one trader may draw it different to another. Overall, the results should be pretty similar if you know what you are doing. Banks do not use this tool. This is the Fibonacci retracement tool, and the common levels where retracements will react are the 0.382, 0.5, and 0.618. For an upwards move, you measure from the bottom to the top, the start of the move to the end of the move. So you'll click on your Fib tool and you'll click and drag to the top of the move, a strong move. So you wouldn't measure it from down here because you had price come down. So you'd measure from the strong move, which is here, and you'll see where it may come down. Price came back, touched the 0.5, and reversed. The complete opposite for a downwards move. So you'd click the Fib tool and you'd click and drag it down from the top to the bottom. So what this is doing is we have a strong move in one direction. So what this tool is measuring is it's measuring the pullback in percentages. So if we click and drag from the top to the bottom, up here would be 100% because it would have 100% retraced. As you can see, it did retrace, but it only retraced 61.8% of this move. So you can use the Fib tool to measure pullbacks after a strong move. I recommend practice drawing these on the H4 and daily charts. So these are obviously higher time frames, but it'll show you how they sort of move. So this is what the tool looks like in trading view. And you can just drag for a downwards move from the top to the bottom, and for an upwards move from the bottom to the top, and just do it over and over again and see what levels you see. The Fib tool can be found here on the left in trading view, and remember for downwards moves we click from the top, drag to the bottom of a move, and we can read the retracement. So from this leg down, we had a retracement of 61%. As you can see, it's touched that key level, which I told you. So we have 618, 0.5 and 0.382 as sort of the levels where price often reacts for some reason. So if you carry on over here, we have another downwards move. So for downwards moves, we go from top to bottom, and obviously it's had more than 100% of a retracement. And then for an upwards move, we drag from the bottom to the top. Bottom to top. And it's come past the 618, and it actually almost had 100%. But this is seen different by every trader. So I might draw this here, whereas someone else might draw it right here after this actual strong move. So it's different for everyone, but what we're measuring is pullbacks. So strong move, what percent did it pull back? That's what we use the fibs for. So it's all fun and games to read market structure, fib levels, the moving average, but you got to remember that news will catastrophically change structure and break your initial plans, and it can happen randomly. So it is important to look at news and see when news is coming out. So I think I do cover this in lesson like 1.5, one of the very early lessons. So have a look at that. And remember to keep an eye on the news. So hopefully what you got from this video is that price is going to react at areas of interest. It's either going to respect those, or it's going to break through them and reject them. Hopefully you also understand that support turns into resistance because it's a key level. Hopefully you also know what wide range bars are, how they're big bank orders, and price often likes to retest those zones. Hopefully you also know how to use the Fibonacci retracement tool and measure pullbacks off of strong moves. So hopefully you understand that these key levels of interest are really only where you should be taking trades, because why would you take a trade in the middle of a range? It could go anywhere. If you wait for it to come to a level, resistance or support, and then have a look at the candles that are forming there, you can avoid stupid losses. The important thing is to remember that price moves from level to level. So if it breaks through a support, it's probably moving to the next support. Some of these levels, such as the fibs or support and resistance, can be seen different from trader to trader. So one trader might see one thing, whereas another may see another. So these are called areas of interest or zones. They're not specific points where price is going to react. It's an area. So price could react somewhere in that area. It's not exact. And you never know exactly where it's going to react, but you know sort of where it may react off a bigger time frame. So in essence, we've just seen where price has touched a lot in the past, and we're waiting to see what the candlesticks are saying in those zones. So we're seeing if it's going to reject it or break through it. If it rejects it, we know we can probably take a long order from there. If it breaks through, we can break through, take a short order, and target the next level of support. So we're using these levels for targets, as well as seeing where we may enter a trade. So we might see a rejection or a continuation move, and we're just touching the same zones over and over again. With that being said, thanks for watching the video, and we got more free stuff coming out. So if you want to see more, I think I'm on lesson 4 or 5 now out of 18. So if you want to see more free stuff, subscribe, and I'll see you later.